Let me start with a thank you to our hosts for the opportunity to speak to this amazing audience. I feared that I would be a little bit of a fish out of water because my work is more historical and more narrative than that of many other people in the room, but we did in fact have a large amount of historical analysis and evidence yesterday afternoon and a little bit already this morning. So I don't feel like I have to justify my focus on the history of financial crises and the comparison of the recent crisis with the Great Depression in particular, but I think it is also important to say something about how to use historical evidence and data, and I will come back to that point. So let me start with the Great Depression. As always, it's important to set the stage. Early work on the Depression, it's fair to say, was heavily closed economy. I'm thinking first and foremost of Friedman and Schwartz's Monetary History, arguably the most influential work on money and banking in the 20th century. Methodologically, Friedman and Schwartz showed how statistical and narrative material could be combined into more than the sum of the parts. They described a model in which shocks to the money stock and the banking system were transmitted to the real economy. They applied their framework to the Great Depression, the ultimate testing ground for any theory of macroeconomic fluctuations. I don't think I'm doing violence, I don't think I'm doing violence to their analysis when I say theirs was essentially a closed economy model in which money and credit were under the control of the national authorities, and in which the gold standard, exchange rates, capital flows were little more than background noise. That was a logical perspective for economists writing in the 1950s and 1960s when open economy considerations were less important than they had been before or than they became since. It was a logical focus for scholars who were concentrating on the United States, a relatively closed economy. But it became less logical once one recognized that the Great Depression was a global phenomenon and that national monetary policies were endogenously determined to a considerable extent, so long as countries maintained fixed exchange rates, as they did for much of the 1920s and the 1930s. This realization was a couple of decades in coming post-monetary history of the United States, I think because the application of modern monetary economics to historical episodes like the Great Depression was initially a practice confined primarily to the United States, where the closed economy perspective was most defensible. The new economic history, as well as what I like to call Yale, MIT monetary economics, like Doug Diamond. I'm also a student of Jim Tobin, also developed first in the United States. So it follows that the first applications of that monetary framework by new economic historians were for reasons of both convenience and predisposition to the United States. I'm not claiming that open economy analyses of the Depression were without precedent. Especially influential were Ragnar Nurksi's international currency experience, written before Friedman and Schwartz, mentioned in passing yesterday afternoon. Some of us had a conversation about it over dinner last evening, and Kindleberger's World in Depression, written subsequently. But in neither case were the statistical and narrative approaches combined as successfully. In neither case was it straightforward to recover the underlying model. So my work, along with that of others, emphasized the global character of the Depression, the gold standard as a constraint, the endogeneity of monetary conditions using models and narrative evidence. It related the singular allegiance of countries to the gold standard, despite evidence of that system's destabilizing effects. It related their adherence to the system to their historical experience with hyperinflation and social conflict during and after World War I, when that regime had been in abeyance. It tried to show how a system that had been stabilizing before 1914 became destabilizing thereafter, owing to changes in the social and political context in which it operated. It sought to explain how that system had become more fragile, owing to the spread of foreign exchange reserves, allowing more money and credit to be pyramided on a narrow base of gold. The more limited credibility of the official and social commitment to gold convertibility because of changes in the social and political setting, and to the declining scope for international cooperation due to the legacies of World War I. It attempted to show how a relatively modest contractionary shock in the United States in 1928-29 could have profoundly destabilizing consequences worldwide by linking money and credit conditions in the United States to money and credit conditions in the rest of the world via the pegged exchange rates and high capital mobility of the gold standard, and by showing how the effects of that shock were amplified by their interaction with the weak balance of payments positions of the countries that had been on the receiving end of capital inflows from the U.S. in the preceding period. There were then a series of amplification mechanisms focusing on money, credit, and banking that made the Great Depression great, and a series of corrective mechanisms eventually ending it. The gold standard, as it operated in the early 1930s, prevented central banks from acting as lenders of last resort, a fact that goes a long way toward explaining the banking panics and bank runs of the period. Those banking crises had negative consequences for economic activity, operating through both monetary and non-monetary channels, as Ben showed in his 1983 article. The collapse of the gold exchange standard then had a deflationary impact and aggravated financial distress by destroying the foreign exchange component of global liquidity. All this made abandoning the gold standard the key to recovery. Abandoning it allowed central banks to act as lenders of last resort. It ended the deflation. It pushed prices back up despite near zero interest rates and liquidity trap-like conditions in countries like Japan, where the authorities were able to decisively alter expectations by pushing down the exchange rate. In countries like Sweden, where they specified a price level target. In countries like the UK, where they committed to a policy of cheap money, of low keeping credit conditions, accommodating for as long as it took. Those measures relieved the pressure for governments to resort to tariffs and quotas to bottle up what had been a fixed lump of demand, given that once monetary policy could be actively used, that fixed lump of demand was no longer fixed. So that's a connection that Doug Irwin and I emphasized in the piece I cite at the bottom here. Many of these positive incomes could have been achieved, of course, without going off the gold standard had countries cooperated with one another on reflationary policies. But there were a number of reasons in practice, ranging from domestic constraints, international tensions, to divergent conceptual models that prevented central banks and governments from cooperating and made unilateral action the only option. So given this, the interesting question is why some countries clung to the gold standard as long as they did. Another way of asking the question is, why did countries and societies draw the specific lessons of history? That's part of the title of the session, that they did. I think that question is important for understanding crises more generally, so I'll return to it given time. We've been asked by the organizers, again in the title they gave this session, to draw comparisons where the obvious comparison is, of course, with the global financial crisis. The policy response this time was different. The policy response this time was better. As everyone knows, central banks were quicker to intervene as lenders of last resort. They were able to do so because few of them had rigid exchange rate targets to defend. It helped that they were quicker to recognize that the crisis was global this time, and therefore extend credit and swap lines to one another and to more broadly coordinate their response. It helped that they had compatible conceptual frameworks, giving rise to shared diagnoses of the crisis and a shared understanding of what was the appropriate response. It helped that they had met regularly as members of the Group of 20 and at the Bank for International Settlements and so forth. I don't want to overpraise the policy analysis and response. We specialists in monetary economics, as Queen Elizabeth reminded us, could have done a better job at seeing the crisis coming and pressed for more effective anticipatory action. We, and I include myself, were focused on the wrong crisis, namely on global imbalances rather than on the housing and housing finance crisis. And I think one reason for that misguided focus was that global imbalances and not a housing crisis or a housing and housing finance crisis had been the leading factor in analyses of the 1920s and the Great Depression. So there was a localized housing boom in Florida and Chicago and elsewhere in the 1920s, but nothing that resembles what we've recently been through. The risks that global imbalances might unwind in a disorderly fashion, as they did historically in 1928, therefore became part of the distilled wisdom about how crises develop. And once the crisis struck, some central banks remained in denial about its global nature, long after this should have been self-evident. I'm thinking about how, for example, the ECB raised interest rates in 2008, implicitly dismissing what was then referred to as the subprime crisis as an American phenomenon. Every crisis, let's see, meant to move to this one. Let me move to this. Every crisis influences the next one. It does so through the interpretation that analysts attach to the last crisis, which is itself influenced by the dominant interpretation of crises before that, and through that channel by shaping changes in financial, regulatory, and other policies. In the current case, we will have to wait and see how enduring those regulatory and other changes turn out to be. One of my arguments, based on the comparison with the Great Depression, is that by preventing the worst, by preventing another Great Depression, policymakers relieved the pressure for root and branch reform of financial markets and allowed forces hostile to more fundamental reform to reassert themselves and begin rolling back earlier reforms more quickly than would have been the case otherwise, as we saw in the United States only last week. So to be clear, I'm not arguing it would have been better to allow the financial system to collapse on the grounds that we then would have had more enduring reform, but I do think it's important to be aware, be conscious of the unintended consequences. It's also important to acknowledge the existence of competing narratives. In the case of the global financial crisis, there are those who would blame not lax regulation or excesses in securitization markets, but Freddie and Fannie. In the case of the Great Depression, there are those who would blame government interference in the operation of markets, Herbert Hoover's high wage policies, or FDR's New Deal. There are those who would blame the policy uncertainty caused by abandoning the gold standard. So I, for one, am not convinced by those alternatives, but it's important to be aware of their existence and to understand why societies converge on certain dominant interpretations of the past, since those dominant interpretations condition, shape perceptions of current events. They influence how policymakers respond and no less what economists model. So there is work in, I show you some of it here, in political science, in sociology, in legal theory, in cognitive science, in history, on the evolution of dominant narratives and interpretations. But I think there is little such work in economics. I think we could do better at understanding model selection and how it's influenced by history. I myself am of the view, like the first set of authors here, that we should view economic models as analogies, and that the nature of our training inclines economists in our effort to converge on a dominant narrative or interpretation to employ not only logical but historical analogies. We therefore need to understand better the nature of analogical reasoning. So this brings me to the final issue. Whoops, go back one. The final issue, that of false analogy. It's relevant to a session with the title Lessons from the Global Financial Crisis and Crises Past. An analogical fallacy, according to Madsen Peary, quote, consists of supposing that things which are similar in one respect must be similar in others. This kind of fallacious reasoning by analogy is a very real problem, I think, when attempting to draw lessons from the global financial crisis and, for that matter, from crises past. My favorite example of that problem is the analogy between the gold standard and the Great Depression on the one hand and the Euro crisis on the other. For about 10 years, it has been popular to argue that because the gold standard collapsed in the Great Depression, the Euro system would collapse in the Great Recession, or framed normatively, it was popular to argue that since countries recovered in the 1930s, only after they abandoned the gold standard, European countries would only recover after they abandoned the euro. They should therefore abandon the euro. This, we now know, was flawed analogical reasoning. Some similarities between the gold standard and the euro there were, but overemphasizing them led commentators to neglect key differences. Reintroducing your national currency when you no longer have one is an order of magnitude harder than devaluing that currency when you still retain it. And the destabilizing financial consequences of even contemplating, of seriously contemplating that option in the case of the euro are considerably greater. The euro was an obligation of, it was governed by an agreement signed by a group of countries, whereas going on or off the gold standard was a unilateral national decision that did not put other international obligations and political relationships at risk. I think these two considerations, one financial and one political, made it obvious that no European country was going to abandon the euro. You can see I wrote these remarks more than a week ago before Italy burst into the headlines, but I'm prepared to defend them nonetheless. I think the comparison between the crisis of the euro and the crisis of the gold standard was valuable. The analogy was valuable because it pointed up the differences in the two cases, not so much the similarity. Leaving me with a final question of why those differences were so widely overlooked. Valid analogical arguments are, quote, based on relevant similarities between two systems. That quote comes from Paul Bartha in this very interesting 2010 book. So how do we determine what is relevant, or at least how do we increase the likelihood that when engaged in analogical reasoning, we focus on the relevant similarities and so forth? I think part of the problem is and was in 2007, 2008, the problem of the, quote, searing analogy. Quote comes from Ernest May, foreign policy scholar. For foreign policy scholars, he observes it's always Munich or it's always 1914, because those are the historical events most deeply seared into the collective consciousness. For scholars of financial crises, it's always the eve of the Great Depression. Related to this, is the fact that too many policymakers have at their disposal a single dominant analogy rather than a portfolio of analogies, each of which they can test for fitness to current circumstances before selecting the most relevant alternative. In other words, I'm arguing that a little bit of historical knowledge is a dangerous thing. Finally, in the case of the gold standard euro comparison, it was necessary in order to determine what was relevant to understand the political, institutional, and historical context of the two systems, and not just master analytical models of their economic and financial aspects. So I would make the same argument about the importance of that investment more generally for drawing lessons from financial crises and indeed for doing good economics.